Now, they may be competing for the speculative fringe in both commodities, but I would suggest as an example that crypto and gold, I don't think of them as competitive asset classes, except as I say, on the fringe. There is plenty of money to be made and plenty of utility in both. Now,
Prepare for an insightful exploration with Rick Rule, a prominent figure in natural resource investments. In this video, Rick Rule predicts the future of gold and cryptocurrency and offers an expert analysis of the economic landscape as we enter the new year. Get ready to glean exclusive insights from an investment luminary.
now, gold moves well, historically, moves well, by well I mean to the upside, when investors are concerned about the maintenance of their purchasing power in conventionally denominated instruments, fiat instruments, in particular important fiat instruments like US dollar instruments. And I believe that investors have a reason to be concerned going forward. In fact, several reasons. The first reason is quantitative easing around the US dollar. James, if you did it, quantitative easing would be called counterfeiting. If you produced wealthions and tried to buy bread with them, they'd put you in prison. But if you were a member of parliament or a member of Congress and did the same thing, you'd be elevated to hero status. Irrespective of the politics, quantitative easing, which is printing more currency without increasing the backing, is in fact counterfeiting. And each existing counterfeited unit does not increase the value of the units that came before it. But a second cause for concern, I think, a second reason why people need to consider owning gold is the credit quality of the debtor, which is to say debt and deficits. I don't know the Canadian equivalent numbers, so my apologies to your large Canadian audience. But in the U.S., the on-balance sheet liabilities of our government, that is, the debts expressed by Treasury securities, exceeds $33 trillion. But that's not the worst of it. The worst of it is the off-balance sheet liabilities, the net present value, not nominal value, the net present value of entitlements, Medicare, Medicaid, Social Security, federal pensions, military pensions, the Environmental Trust Fund. These numbers, recourse obligations to the taxpayer, exceed, by the estimate of the Congressional Budget Office, $120 trillion. So at the federal level in the United States, not including state and local governments, we owe each other, or rather, the spenders owe the savers, some number over $150 trillion. And we're addressing this debt with a budget that's in deficit $2 trillion a year. By the way, before the impact of higher interest rates on the servicing of the government debt. This should make any saver in US dollars concerned. But I think it actually gets a little worse, and that's the specter of inflation. Many of your listeners will believe that inflation is under control. Inflation is measured by the CPI. But I don't think that the CPI is a measure of the deterioration of the purchasing power of your currency. In the first instance, James, the CPI is hedonistically adjusted, which is to say that the imputed value of your computer or your house is determined by a cabal of big thinkers who control the index. Of course, when it is inconvenient, the index doesn't include food or fuel, which I guess would be relevant to me if I neither ate nor drove, but I do. But the strangest part of the CPI as a cost of living index is that it doesn't include tax. For working Canadian and American households, tax is their largest cost of living, larger than shelter, larger than food, larger than transportation, and larger than energy combined. I believe that the basket of goods and services I purchase means that the purchasing power of my savings is declining at about 7% compounded. So if you think about the concern I might have as a saver in US dollar denominated instruments, let's do the arithmetic. The US 10-year Treasury is, of course, the benchmark security and the benchmark saving asset worldwide. That instrument purports to pay savers 4.3% in a currency that I suggest is declining in purchasing power by 7% compounded, which means that if I lend the US government money for 10 years, in other words, I buy the US 10-year Treasury, I am losing 2.7% of my purchasing power every year compounded for 10 years. Now, what is it on earth that could make me more concerned about the efficacy of saving in US dollars than an absolute government guarantee that they're going to take 2.7% of my wealth away from me every year? For those reasons, I believe I have to own gold. But there's a little more arithmetic, James, I want to leave your audience with. The market share of precious metals and precious metals investments in the United States relative to all forms of savings and investment assets stands below 0.5%, which is to say gold and silver and precious metals related assets, mining stocks and the like, comprise less than 0.5% of all the savings and investment assets in the United States. That's down from a 4-decade mean of 2%. I believe, because of quantitative easing, debt and deficits, and negative real interest rates, that we will at the very least revert to mean. And if I'm right, that means that demand for this asset class will quadruple. And I think it'll do that in 5 years. You'll remember that I mentioned the year 2000 as being the year when the gold price move started. And I think that's useful too. People spend too much time wondering whether the price of gold will break 2,000 or will break 2,200. I own it because when gold gets on the metaphorical bicycle, it really moves. In the period 2000 to 2011, it moved from $250 an ounce to $1,850 an ounce. I don't own gold because I think it might go to 2,500. I buy gold because I'm afraid it'll go to 8,000 or 9,000. That's why I own gold. It's important to note, too, that you don't have to go overboard. Gold is a form of insurance that when it pays off in spades. So the purchase of a little bit of insurance buys you an awful lot of coverage over time. Imagine the holder of gold in 2000 owning gold as to, 4 or 5% of their portfolio, seeing the price of gold go up sevenfold. It would have taken real damage in other parts of the portfolio for gold not to have been able to do its job and shelter the holder's purchasing power. I think that's a convenient excuse, but I don't think it to be true. The global value of savings and investment assets around the world is estimated now by the World Bank to exceed $750 trillion. The market capitalization of gold or the market capitalization of crypto relative to that number is about as significant as a pimple on an elephant's behind. It doesn't matter. Now, they may be competing for the speculative fringe in both commodities, but I would suggest as an example that crypto and gold offer very different utilities. Crypto being an allegedly anonymous, frictionless medium of exchange, and gold being a primary store of value. I can see arguments for owning either. I don't think of them as competitive asset classes, except, as I say, on the fringe. There is plenty of money to be made and plenty of utility in both. Now, for the speculators, which is to say for the people involved in the more speculative part of the gold trade, the junior gold shares, there is probably direct competition between the speculators in crypto and the speculators in junior mining shares. Although they're very different asset classes, I think that the mentality of the participants is similar. So in that case, there probably is competition. I think perhaps that's true, but I think there's also an awful lot more capital since 2000. So both the numerator and the denominator have grown. What I think has really happened is that the cost of capital has come down for 40 years, which has spawned the attraction of a whole range of asset classes that wouldn't have existed in the absence of free capital. We wouldn't have an Amazon today were it not for Amazon's very, very low cost of capital. We probably wouldn't have a crypto today as a consequence of the low cost of capital. 40 years of declining interest rates have increased investor confidence at the same time that they've lowered the cost of capital. My suggestion is that while I'm not a real doom and gloomer, the next 10 years are going to be more challenging than the last 40 years have been. And they're going to usher in an epoch in human history where the type of investments that were favored by a low cost or a no cost cost of capital are going to be shunned. in favor of asset classes that have traditionally done well in challenging environments, gold being one of those. Well, first of all, I think that our lives are going to continue. And I think 15 years from now, we'll be better off, immeasurably better off than we are today. But I think we have to get from here to there. When you say U.S. debt levels have been increasing, the thing that bothers me is that U.S. debt levels relative to GDP have been increasing. As an example, at the time of the 2008 financial crisis, when the United States was able to spend and or print its way out of circumstances, aggregate U.S. government debt was between 25 and 30% of GDP. Now that same number is 110% of GDP. So the ability of the big thinkers, of the central planners, to print or to spend our way out of difficulty is more constrained simply because of the relationship between debt and GDP. In other words, there's less room. The second thing I think, and I don't know if I think this, the second thing that I'm afraid of is that the circumstance that we're going into could cause confidence to diminish. This confidence in the economy, this confidence in markets, this confidence in the future was born of an epoch, I would suggest 1982 to 2022, the most benign climate in economic history, I would suggest. And if you have a diminishment in confidence, the ability of the big thinkers to talk our way out of trouble is diminished. I am not one who says that a liquidity event circa 2008 is imminent, but I do think that if you have any diminishment in confidence, and I think that there are reasons for a diminishment in confidence, that the probability of a 2008 style event increases at the same time that the government's ability to deal with it, because of the increased level of debt relative to GDP, is a real cause for concern. By the way, I don't want to be right. I'm one of those weird guys who owns a lot of gold and who hopes the price of gold doesn't go up. I hope when I shed my mortal coil, or when I'm about to shed my mortal coil, I turn around and say, you know what, Rick, all that insurance you bought was for naught. Thank God. The set of circumstances that causes the gold price to go to 5 digits is a set of circumstances that makes the rest of your life a lot more miserable.
Thank you for being part of this enlightening discussion led by Rick Rule's expertise. We trust his perspectives on gold, cryptocurrency, and the economic outlook have broadened your investment horizons. As you navigate the exciting world of investments, remember these insightful takeaways. Don't miss out on more expert insights and exclusive discussions. Hit subscribe and ring the bell to stay ahead in your investment game. Until next time, let's keep growing wealth one savvy move at a time.